Uranium went from $20 a pound to over $100, a 5x move in under a decade. 7 US listed stocks let you play this supercycle. One is a $51 billion blue chip with 230 million pounds under contract. One just opened its first mine last month. One has zero revenue and trades at $8 billion. Same commodity. Completely different bets. And the supply gap is widening. 30 to 40 million pounds per year of structural deficit, the world's largest producer deliberately cutting output, and secondary supply sources that kept this market balanced for decades are running dry. This is the uranium supercycle, and your entry point depends entirely on which stock you buy. 3 questions this episode answers. First, why is uranium in a structural supply deficit that no amount of capital can fix overnight? Second, which of the 7 US listed uranium stocks actually captures the supercycle, and which ones are priced for a mine that doesn't exist yet? Third, what is the enrichment bottleneck that almost nobody talks about, and who profits from it? Let's start with the market. Uranium hit $101 per pound in January 2026, the highest since the Fukushima spike in 2011. The long-term contract price, which is what actually matters in this industry, climbed to $90, the highest since 2008. Global reactor demand, roughly 180 to 200 million pounds per year. Mine production, 173 million. That is a 30 to 40 million pound annual deficit. How has the market stayed supplied? Secondary sources: government stockpiles, enrichment underfeeding, recycled uranium. These filled the gap for over a decade. But secondary supply has been declining from 14% of total supply toward an estimated 4% by 2050. The buffer is disappearing. 3 countries produce 75% of the world's uranium: Kazakhstan at 39%, Canada at 24%, Namibia at 12%. 78 reactors are under construction globally. China alone has 28, half of all nuclear construction on Earth. Goldman Sachs estimates a cumulative deficit of 1.9 billion pounds through 2045. This is not a cyclical price spike. It's a structural repricing. The world's largest uranium producer is deliberately not producing at full capacity, and it just told you it won't. Kazatomprom controls 39% of global mine production. In 2025, it produced 67 million pounds. Its 2026 guidance, 71 to 75 million pounds, roughly 10% below nominal capacity under its subsoil agreements. The company explicitly stated that the current supply-demand balance does not justify a return to full production. Why not just open new mines? Because uranium mines take 10 to 15 years from discovery to first production. The industry spent 13 years, the entire post-Fukushima era, underinvesting in exploration and development. You cannot fix that with capital alone. You need time. The 2 most important new projects just received construction permits. NexGen Rook I, the largest undeveloped high-grade uranium deposit in the world, capable of 30 million pounds per year at peak, was approved in March 2026. First production, approximately 2030. Denison's Wheeler River received its license in February. First production, mid-2028. Even with both online, the combined output won't close the gap. And both are years away. The deficit is here now. New supply is not. 7 US listed stocks. 1 commodity. Very different stages, very different risks. Cameco, ticker CCJ, 51 billion market cap, 3.5 billion in revenue, 21 million pounds produced, 230 million pounds contracted. The blue chip. Sprott Physical Uranium Trust, ticker SRUUF, 7.1 billion. Not a miner. Holds 78 million pounds of physical uranium. Bought nearly 9 million pounds in 2025, 3 times the prior year. NexGen Energy, ticker NXE, 8.2 billion. Zero revenue. Rook I approved but 4 years from production. You are paying for a deposit, not a business. Uranium Energy Corp, ticker UEC, 7.3 billion. Revenue 67 million. Just started Burke Hollow, the world's newest operating uranium mine, in April 2026. US-based ISR production. Energy Fuels, ticker UUUU, 5 billion. Revenue 79 million. The dual thesis play, uranium plus rare earth oxides. Produced dysprosium and terbium at White Mesa Mill. Commercial scale rare earth production targeted for Q4 2026. Centrus Energy, ticker LEU, 4 billion. Revenue 449 million. The only U.S. company producing HALEU high-assay low-enriched uranium for next-generation reactors. $900 million DOE task order. Backlog, $3.8 billion. Denison Mines, ticker DNN, $3.3 billion. Wheeler River construction started March 2026. Earliest new mine production among the pre-producers at mid-2028. Cameco is the Linda of uranium. The disciplined supplier. Fiscal 2025, $3.5 billion in revenue. Net earnings $590 million, up nearly 3.5 times from the prior year. Adjusted EBITDA $1.93 billion. Operating cash flow $1.41 billion. The company is generating serious cash at current uranium prices. Two world-class assets, Cigar Lake and McArthur River Key Lake, both in the Athabasca Basin in Saskatchewan, which contains the highest-grade uranium deposits on Earth. Combined production, 21 million pounds in 2025. But the real story is the contract book. Cameco has 230 million pounds under long-term contracts. Its strategy is explicit: match production to contracts, not chase spot prices. This means Cameco does not flood the market when prices rise. It sells into locked contracts at predetermined escalation terms. Disciplined supply management, exactly like Linda in industrial gas. The stock is near $51 billion market cap at $125 a share. Cash and investments, $1.2 billion. This is not cheap, but it is the franchise. If you believe in the uranium supercycle and want to sleep at night, this is the position. 3 companies, 3 timelines, 3 risk profiles. Uranium Energy Corp just started production at Burke Hollow, Texas, the world's newest ISR uranium mine, operational since April 2026. It also acquired Rio Tinto's Sweetwater plant in Wyoming for $175 million, adding 4.1 million pounds per year of processing capacity and 175 million pounds of historic resources. Market cap, $7.3 billion. Revenue, $67 million. The gap between valuation and current revenue is enormous, but UEC is the only US-based pure-play producer actually delivering pounds today. NexGen Energy is the highest risk, highest reward play. Rook I's Arrow deposit could produce up to 30 million pounds per year, roughly 20% of current global supply from a single mine. Construction starts summer 2026. First production around 2030. Market cap, $8.2 billion with zero revenue. If Arrow delivers on its resource estimate and uranium stays above $80, NexGen could be a generational asset. If construction delays or uranium corrects, the downside from $8 billion with no cash flow is severe. Denison sits in between. Wheeler River's Phoenix deposit uses ISR mining, lower capex, faster timeline. Construction started March 2026. First production, mid-2028. Market cap, $3.3 billion. Among pre-producers, Denison offers the best balance of timeline and valuation. Everyone talks about uranium supply. Almost nobody talks about enrichment, and it may be the tighter bottleneck. Natural uranium is 0.7% U-235. Reactor fuel needs 3 to 5%. Getting there requires enrichment, measured in separative work units, or SWU. And here is the problem: Russia's Rosatom controls 40% of global enrichment capacity. Urenco, the Western Consortium, has 26%. Orano in France, 12%. China has 22% but uses it domestically. Western utilities consumed roughly 14 to 15 million SWU per year. Total non-Russian, non-Chinese capacity, roughly 24.5 million. In theory, sufficient. In practice, demand is surging while expansion takes years. Centrus Energy, ticker LEU, is the US play on this bottleneck. It is the only American company producing HALEU, the high-assay fuel required for next-generation reactors. The DOE selected Centrus for a $900 million task order to expand its Piketon, Ohio facility. Total backlog, $3.8 billion. Revenue, $449 million. Market cap, $4 billion. Urenco is expanding. Phase 1 at its New Mexico plant started production in May 2025, but won't finish until 2027. The enrichment gap is real and closing slowly. So where does Sprott fit in all of this? Sprott Physical Uranium Trust holds 78.4 million pounds of uranium. Assets under management, $7.1 billion. In 2025, it purchased 8.7 million pounds, nearly triple the 3 million it bought in 2024. It started 2026 by buying 100,000 pounds on the first trading day. Q1 alone, 3.7 million pounds. This is not a mining company. It is a financial vehicle that physically buys uranium off the spot market and locks it in a vault. Every pound Sprott buys is one less pound available to utilities. In a market already running a 30 to 40 million pound deficit, this creates a reflexive loop. Higher prices attract capital to Sprott, which buys more uranium, which tightens supply further, which pushes prices higher. Think of it as a uranium ETF with physical settlement, except unlike gold ETFs, the uranium spot market is tiny. Sprott's annual purchases now represent roughly 5% of global mine production. That is material. For investors, SRUUF is the simplest way to get uranium price exposure without mining risk, management risk, or development risk. The trade-off: no operating leverage. If uranium doubles, a miner's stock may triple. Sprott tracks the commodity. My read on how to approach this sector. Blue chip, Cameco. The franchise. 3.5 billion in revenue, 230 million pounds contracted, disciplined supply management, world-class Athabasca assets. Not cheap at 51 billion, but this is where institutional capital goes. If uranium stays above $80, Cameco compounds. Enrichment monopoly, Centrus Energy. The only U.S. HALEU producer. $900 million DOE contract. $3.8 billion backlog. The enrichment bottleneck is less crowded than the mining thesis, and LEU is the purest play. Growth, 3 tiers of risk. UEC is producing today, the safest growth bet but expensive at $7 billion on $67 million in revenue. Denison is mid-2028, the best risk-reward among pre-producers. NexGen is 2030 and priced for perfection at $8 billion with zero revenue, position size accordingly. Dual thesis energy fuels. Uranium plus rare earth oxides from the same facility. If the rare earth commercial ramp succeeds in Q4 2026, the stock re-rates on a completely different narrative. Optionality you don't pay much for. Commodity vehicle, Sprott. Pure uranium price exposure. No mining risk. The reflexive buying loop is real, but so is the downside if uranium corrects and capital flows out. 3 signals worth tracking over the next 12 to 18 months. First, Kazatomprom 2027 production guidance. If Kazakhstan stays below nominal capacity, as it has for 2 consecutive years, the structural deficit widens and the floor under uranium prices firms. This is the single most important supply variable in the entire market. Watch the annual guidance release, typically in January. Second, NexGen Rook I construction progress. Groundbreaking is planned for summer 2026. Any delays compress the timeline to first production and challenge the $8.2 billion valuation. Conversely, if construction stays on schedule and uranium holds above $80, NexGen re-rates. This is the most important binary catalyst among uranium equities. Third, Western enrichment expansion. Urenco Phase 1 completion at its New Mexico plant is targeted for 2027. Centrus HALEU contract negotiation determines whether the U.S. builds meaningful domestic enrichment capacity. If both advance on schedule, the enrichment bottleneck eases. If either slips, LEU and the enrichment thesis become even more compelling. Watch DOE appropriations and Urenco quarterly updates. My base case: uranium stays above $80 through 2027 as secondary supply continues declining. Cameco compounds. UEC and Denison begin delivering production. NexGen remains a 2030 story, high reward, high risk. The supercycle is structural. The only question is which stock matches your time horizon. I'm Big Z, follow me, see you in the next deep dive.